Welcome to The Explainer. Today we are tackling a big one, how people actually get rich. We're going to break it all down into a clear, actionable framework, just 3 fundamental paths to building serious wealth.
So let's start with a really bold claim from our source material. The idea is that getting rich, it's not some big mystery. It's a process, and it almost always follows one of 3 distinct paths. Now, the paths themselves are pretty straightforward. But, and this is the big but, the execution, that's what separates the dreamers from the doers.
Okay, so here's the plan for the next few minutes. We're going to walk through those 3 paths. First, building the machine yourself. Second, buying a machine that someone else built. And third, joining a powerful system. And stick around because at the end, we'll reveal the one single principle that connects all of them.
All right, let's jump right in. Path number 1. This is what I call the creator's path. It's for the founders, the builders, the people who look at the world and decide to build a value-producing machine from absolute scratch.
And look, this isn't just a feel-good story. The data is crystal clear on this. You look at wealth reports from places like UBS or Forbes, and they all say the same thing. Entrepreneurship is, by far, the biggest engine for creating new billionaires. And the formula? It's always the same. They build something, they own a piece of it, and then they scale it to the moon.
Okay, and this right here, this is the absolute core of the builder's path. It's the massive difference between income and ownership. Think about it. Your salary, even a really great one, grows in a straight line. It's tied to the hours you work. But equity, your ownership, that's completely different. It's nonlinear. It can grow exponentially, like a rocket ship, totally disconnected from your time.
And here's how that crazy growth actually happens. It's a concept called equity repricing. It's not just about the company making more money. See, when a business really takes off, the market changes how it values the whole thing. It might go from being worth, say, 4 times its revenue to 8 times its revenue. So if the revenue doubled, your ownership stake didn't just double, it could have quadrupled. That's the magic moment when wealth just appears. So our source material lays out this really clear 5-step playbook for how you build this engine. You spot an inefficiency, you create a repeatable solution, you standardize how you deliver it, and then you scale up distribution. Simple enough, right? But here's the catch, and it's a big one. So many people get those first 4 steps right, but they stumble on the last one, retaining ownership. They give away too much of the pie, and they miss out on the life-changing wealth.
And this really hammers home a critical truth that a lot of first-time founders miss. You can have the best product in the world, but if nobody knows about it, it's worthless. The real leverage, the real power, isn't just the product. It's controlling distribution and keeping your margins healthy. That's the fuel for the whole growth engine.
Now, we have to be honest here. This path sounds great, but it is absolutely brutal. The vast majority of startups fail within 5 years. That's just a fact. The returns are governed by a power law, meaning a tiny handful of huge home runs pay for all the strikeouts. And the psychological cost? It's immense. You have to be okay with living in a state of extreme uncertainty, and not many people are wired for that.
Okay, so if the idea of building from scratch sounds, well, terrifying, that brings us neatly to path number 2, the investor's path. The idea here is simple. Instead of building the machine, you just buy ones that are already working.
The engine that drives this path is one of the most powerful forces in the universe, compounding. It's a fancy word for a simple idea. Your money earns a return, and then that return starts earning its own return. You're basically letting time and existing cash flow do all the heavy lifting for you. And you can see it right here on this chart. It feels so incredibly slow at the beginning. That first decade or so, you might feel like you're getting nowhere. But then, look at what happens. That curve starts to bend upwards. And then it goes almost vertical. Time is the secret ingredient here, and the growth in those later years is just explosive.
So what kind of machines are we talking about buying? Well, it's things like stocks, rental properties, private businesses, basically anything that generates cash or goes up in value without you having to trade your time for it. You're essentially buying a little piece of an economic engine that's already running.
And here's the thing that's so important to get about this path. Your edge isn't being brilliant. It's not about trying to outsmart the market or pick the next hot stock. The real superpower is consistency. It's just staying invested month after month, year after year for a very long time. Patience beats brilliance every single time.
All right, on to our third and final path. And this one is interesting. It's kind of a hybrid, a bridge between the other 2. This is for people who don't have a bunch of money to invest right now, but also don't want the extreme risk of building from scratch. This is the insider's path.
The strategy is to get a job inside a system with huge leverage. Think finance, big tech, specialized law, places where you can earn an outsized income. Then, and this is the key, you take that big income and you methodically turn it into ownership. You convert your salary into the assets we just talked about on the investor path.
You might wonder why people in these fields get paid so much. Well, it's not an accident. Their compensation is a direct reflection of the massive scale of the systems they're a part of. They're working with huge amounts of capital or technology, and that allows them to generate the serious seed money they need to start building their own portfolio of assets.
This timeline lays out the journey perfectly. It's a multi-phase process. Phase 1, you get really good at a valuable skill. Phase 2, you pick the right high-leverage system to apply that skill in. Phase 3, you get as close to the flow of capital as you can. And then, the most important part, Phase 4, you aggressively convert every spare dollar you make into assets until you hit Phase 5, detachment, where your assets are doing all the work for you. And let me just double down on this point, because it's the place where most people on this path fail. That conversion phase is everything. You have to treat it like a mission. Every bonus, every stock grant, it goes straight into the compounding engine we just discussed. You have to do this before lifestyle inflation. You know, the new car, the bigger house, before that has a chance to eat away all your capital.
Okay, so we've got 3 very different approaches here, right? You can build it, you can buy it, or you can join a system to earn the money to buy it. They seem so different on the surface, but what's the one thing they all have in common? What's the unifying principle?
And this table does a great job of summarizing the trade-offs. The builder's risk is execution failure. The buyer's risk is market volatility. The insider's risk is your career stalling out. Different risks, different timelines, different games, really.
But here it is. This is the big reveal. The one thing that connects all 3 paths. It's ownership. It doesn't matter how you get there, whether you build it, buy it, or earn the money to acquire it. The fundamental truth is that real, sustainable wealth flows to ownership. It does not flow to labor.
So there you have it. 3 paths, 1 destination, owning productive assets that work for you so you don't have to. Each one has its own set of rules, risks, and rewards. And that leaves us with just one final question to think about. Which one of these paths is yours?